Welcome back to Algobot, the channel where we break down automated trading strategies for MetaTrader 5, one line of code at a time. I'm your host here at Algobot, and in today's session we're exploring an expert advisor called Capacitive Charge Reversion. This is an original mean reversion strategy built from first principles. It borrows an idea from electronics, the charging and discharging of a capacitor, and applies it to price. By the end of this video, you'll understand how it measures displacement, how it builds and releases charge through a custom oscillator, and how it signals its entries and exits. Remember, this is educational content only. Let's get started. So what exactly does the Capacitive Charge Reversion Expert Advisor do? At its heart, this is a mean reversion strategy. That means it looks for moments when price has stretched away from its own recent average, and it positions for a move back toward that average, the market's local equilibrium. It's designed to run on a single primary symbol and time frame, and because every calculation recomputes on each new bar, it adapts itself to whatever market and time frame you attach it to. The indicator driving this strategy is not a standard, off-the-shelf tool like a moving average or a stochastic. Instead, it's an original construction the author calls the charge. Think of a leaky capacitor from an electronic circuit. Price displacement away from the average acts like a voltage. When price stays persistently on one side of its average, that voltage keeps pumping charge into the capacitor faster than it can leak away. A single brief spike barely registers, because it leaks off almost immediately. But sustained, one-sided drift builds up stored charge, and that stored charge represents the market's reversion potential. The strategy then measures how far this charge has built up relative to its own recent volatility. When the charge climbs to an upper threshold band, the market is considered overcharged to the upside, and the strategy signals a sell, fading back toward equilibrium. When the charge falls to a lower threshold band, it's overcharged to the downside, and the strategy signals a buy. Risk on every position is bounded by the average true range, a common measure of volatility, which sets both the stop loss and the take profit. Who is this style suited for? Educationally speaking, it's an example of a counter-trend, mean reversion approach, the kind of logic that interests traders who want to study how markets behave after stretched moves. As always, this is for learning purposes only, and trading always carries the risk of loss. Let's walk through the mechanics step by step, exactly as the code performs them on each newly closed bar. The expert advisor acts once per bar, never inside a forming bar, so its signals don't repaint. First, it establishes the local equilibrium. It takes the average of the closing prices over the last window bars, 20 by default. This baseline is the market's recent center of gravity. Second, it measures how spread out prices have been around that baseline using the mean absolute deviation, the average distance of each close from the mean. This gives a robust scale that is less sensitive to outliers than standard deviation. Third, it computes what the author calls the voltage. This is simply the current close minus the baseline, divided by that scale. In plain terms, it's how many typical deviations price currently sits above or below its average, a normalized displacement. Fourth, this voltage is fed into the leaky-integrator to update the charge. The previous charge is multiplied by the decay factor, 0.8 by default, and the new voltage is added on top. Because the old charge is shrunk by the decay each bar, a one-off spike fades quickly, while persistent displacement in the same direction accumulates into a large charge. Fifth, the strategy builds a self-calibrating threshold. It takes the standard deviation of the charge itself over the charge window, 100 bars by default, and multiplies it by the threshold multiple, which is 2. Because the threshold comes from the charge's own recent volatility, there are no fixed levels. It adapts to each symbol and time frame automatically. Now the signals. When the charge rises to or above the positive threshold, the market is overcharged upward, and the EA signals a sell to fade back toward the baseline. When the charge drops to or below the negative threshold, it's overcharged downward, and the EA signals a buy. Every trade is protected. The stop loss is placed at a multiple of the average true range away from entry, 2 times ATR by default, and the take profit at 3 times ATR, giving a reward-to-risk ratio of about 1.5 to 1. Finally, exits. The EA holds one position at a time. It closes when the charge discharges back inside the exit band near 0, 30% of the threshold, or if the charge flips all the way to the opposite extreme. The ATR stop and target remain in place as the outer risk bounds throughout. Let's read through the core of the MetaQuotes code, just as you'd see it in MetaEditor. At the top are the input parameters. Window sets the equilibrium averaging length at 20. Decay is the leaky-integrator factor at 0.8, controlling how quickly old charge fades. Charge window, 100, is the look-back for the self-calibrating threshold, and threshold multiple, 2, scales that threshold. Exit fraction, 0.3, defines the discharge band for exits. ATR period, stop ATR multiple, and take ATR multiple govern the volatility-based risk bounds, and lots sets the fixed trade volume. Just above the signals, the code computes the threshold as the multiplier times the charge's standard deviation and the exit band as a fraction of that threshold. Now the two signal blocks. The first condition checks whether the charge, GQ, is greater than or equal to the threshold. If it is, the market is overcharged upward, so the code reads the bid price, sets the stop loss above entry at stop HAR multiple times ATR, sets the take profit below entry at take HAR multiple times ATR, and calls trade.sell to open a short position labeled CC or short. The second block is the mirror image. If instead the charge is less than or equal to the negative threshold, the market is overcharged downward. The code reads the ask price, places the stop loss below entry, the take profit above entry, and calls trade.buy to open a long position labeled CC or long. Notice how symmetric it is. The buy and the sell are exact reflections of each other, each fading the accumulated charge back toward equilibrium, and each bounded by the same average true range risk logic. Now let's bring it all together on the chart. Below the candles you can see the strategy's own indicator, the capacitor charge, plotted in gold. It oscillates around a central equilibrium line at 0. The red dashed line above is the sell threshold, the green dashed line below is the buy threshold, and the shaded zones mark where the market becomes overcharged. Watch how the charge builds and releases as price moves. We begin on the left with the first few candles drifting steadily lower. Each red candle closes below the slow baseline line drawn across the price, the equilibrium. Notice this isn't one sudden drop, it's a persistent, one-sided slide. And that persistence is exactly what the charge is designed to capture. In the subpanel, the gold charge line is sinking lower and lower, bar after bar, because price keeps pumping negative voltage into the leaky integrator faster than it can leak away. By the fourth candle, price prints a fresh low, and the charge finally sags into the green overcharge down zone, touching the buy threshold. This is the signal. The market is now considered overcharged to the downside, stretched too far below its equilibrium, and the strategy places its buy entry, shown by the green buy marker. At that same moment, the stop loss is set a couple of ATR multiples below the entry, just beyond the fresh low, and the take profit is projected up toward the baseline. Now watch the reversion. The next candles turn green and begin climbing back toward the equilibrium line. As price lifts, displacement shrinks, so the charge starts discharging. The gold line rises back up out of the green zone toward 0. By the seventh candle, price has reverted up into its baseline and reaches the take profit target, marked in gold. The long trade closes for a completed move back to equilibrium, exactly as the discharge logic intends. With the charge now back near 0, the capacitor is neutral again, and the strategy waits patiently for the next imbalance. It doesn't take long. The following candles begin drifting persistently higher, one green bar after another, pushing price above the baseline. This time the charge is filling with positive voltage, and in the subpanel the gold line climbs steadily toward the upper band. By the 10th candle, price has stretched to a high and the charge pushes into the red overcharged up zone, touching the sell threshold. That's the mirror image signal. The market is overcharged to the upside, and the strategy places its sell entry, shown by the red sell marker. The stop loss is set a couple of ATR multiples above the entry, just beyond the high, and the take profit is projected back down toward equilibrium. And once more, price reverts. The candles roll over into red and slide back down toward the baseline. As they do, the charge discharges again. The gold line falls out of the red zone and heads back toward 0. By the 13th candle, price has come back down into its equilibrium and reaches the lower take-profit target, closing the short trade. Step back, and you can see the rhythm the whole strategy is built around. Persistent one-sided drift charges the capacitor. When the charge reaches a self-calibrating threshold, set at 2 times its own recent volatility, the strategy fades the stretch. And as price moves back toward equilibrium, the charge discharges and the position is closed. Both trades use the identical logic, just in opposite directions. Remember, this is a clean illustration. In live markets, price does not always revert, stops are hit, and losses occur. This walkthrough is for educational understanding only, not a prediction of results. And that brings us to the end of our breakdown of the Capacitive Charge Reversion Expert Advisor. Today we covered the core idea of treating price displacement as a voltage and stored reversion potential as charge. We walked through the baseline, the leaky-integrator, and the self-calibrating threshold. We read the actual MetaQuotes code for both the buy and the sell signals, and we illustrated a long and a short trade on the chart. Everything you've seen here is educational information only. It is not financial advice, a recommendation, or a solicitation to trade. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling us which strategy you'd like us to analyze next. You'll find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.